Let's get to our next guest on the unusual volatility that we've seen this week in the markets and how it plays as an investor. Joining us is David Gerstenhaber. He is Acorn Advisory Capital CIO. And David, it's great to see you.
Becky, nice to see you.
Thank you for joining us. It's been a while.
Has been.
I think October 15th was the last time you were here.
Exactly.
I looked back at some of the calls you made then, and it turned out they were pretty prescient. A lot of what you were saying at that time has followed through. So let's kind of run through some of those calls and maybe see if you want to double down on them or change your opinions.
Sure.
First of all, you said you thought the stock market has probably seen most of its gains, that we'd be trading relatively flat. When you said that, I think we were around 27.50, so you're pretty much right on with that. That's still the case? Do you worry about this?
I don't have a very upbeat message. I don't have a particularly downbeat message either. I'd put it this way. I think it's going to be a frustrating period for investors, and we should expect pretty muted returns from financial assets. Bonds are rich. We can debate that a little bit, but coupons are obviously low. What you're going to get on bonds is low. And stocks, we don't really have any substantive profit growth at this point. The market tends to struggle when it gets above 17 times earnings, which is kind of where we are now. We struggled there earlier this year. We struggled there last month, earlier this month. And the multi-decade average is more like 15 times earnings, which would imply something closer to 2,600 on the S&P. Now, interest rates historically have been higher. And so the question is, do you want to use a different discount factor because interest rates are now substantively lower than they were and value the market higher? But at some point, you want to pay for growth. And all we're getting now is a little bit of earnings per share growth reflecting buybacks, but no underlying profit growth at this point.
I want to jump in on that because, Rick, this kind of plays into your thesis and what we were talking about earlier today. Just with interest rates so low that you could see some expansion of earnings multiples, and especially with growth stocks.
Not only that, I mean, you think about, you got to balance two things. One, the reason why interest rates are so low is the demographic and the growth potential is lower, which feeds right into the equity market. But if you drop the rate low enough, the discount rate means that equities, when you think about a portfolio balance channel, you should have a higher weighting to equities when you press down the discount rate.
You guys are both really smart and have thought a lot about this. What do you think, David?
Look, I think you have to put your money somewhere. And you know what you're going to get in 10-year bonds right now, 1.5% over time. Maybe you get a capital gain if rates keep dropping for a period of time, but that's what you're going to get.
When they go negative, you'll be rich.
And we should address the negative interest rate thing in Europe because it's really driving down our rates. And one thing that I think at some point we should address is, do we think the Fed is going to cut as much as the market's pricing? It's 110 basis points from here into the middle of next year. They're supposed to manage our economy, not the global economy. And it's not clear to me that given how our economy is behaving, that level of interest rate cutting is warranted.
What do you think you'll get this year?
Well, the market's pricing in excess of another 75 basis points out to the end of next year. And I guess the question is, and I heard some of what you guys were discussing before, does the Fed panic or not? We're pricing over, into the mid-30s in terms of basis points cuts for the end of September. A typical mid-cycle adjustment for the Fed is a total of 75 basis points. And so the question is, do they want to ratify what the bond market has done with a 50 basis point cut in September? And this would be on the heels of 2 dissents at the last meeting for the cut overall. Or do they want to stick with 25 basis points, in which case the market may be somewhat disappointed?
Rick thinks that they should cut 50 at the next meeting. What do you think?
Well,
it sounds like you're leaning more towards 25.
I'm leaning more towards 25, but I think it's a very tough call in terms of what they do, because the bond market has rallied so far that they will disappoint the market if they only go 25. There's no question about that. But when I look at what's going on in the economy, the consumer's in fine shape. The retail sales data has indicated that. The employment market is fine. Yes, the gains have slowed decisively from where they were, but we're still creating far more jobs than is necessary to sustain the unemployment rate at these low levels. We have a much more service-oriented economy than a manufacturing-oriented economy. It's true that manufacturing globally is effectively in recession right now, but it hasn't really spilled over to the service sectors in the advanced industrial economies, and particularly not in the United States.
So you don't see a recession?
I don't see a recession at this point, no. And the typical precursors of a recession aren't really present. You have very high consumer sentiment. You have a high savings rate, with the exception perhaps of high corporate debt and the high budget deficit. You don't have the typical imbalances that would precede a recession.